the CPI data, if you look at the core, is basically where it was in the second half of last year when we were really worried about CPI. I mean, it's very stubborn. Services inflation, I realize, we're 15-month lows. This is part of what the Fed's debating. We know about the labor data where there's essentially 1.79 positions that need to be filled for every person actually out there looking, which is more than 2 times the natural average. So the macro is certainly says Fed needs to remain, and it will be a hawkish pause tomorrow. Look at Fed fund futures. We are now actually between now and year end, rates go higher, not lower. So, I mean, this is pretty dramatic what's happened over the last couple of days. Nobody's pricing in lower rates, which is interesting to see that equities aren't flinching. At one point, part of the equity rally was based upon rates will come down and all the math that you do when you're doing a discount, doing an equity model or discount rate, et cetera. So interesting times. I think it's positioning for equities right now, where people are, cash levels, sentiment. Really, it dictates that actually all that easy, pain trade stuff, I think, is getting a little bit long in the tooth.
I agree with almost everything Tim said. I think, to the extent that the Fed is data dependent, the data supports them continuing to raise, actually. I know this was a little bit cool, but still, if you look at the absolute number, it's way higher than it needs to be. So I think they can pause if they want. I'm not really sure what it gets them, actually. So if I were they, I would continue to raise. We talked about it the other day, 25 basis points one way or the other doesn't really matter. No, I think the rhetoric matters just as much. But if I were there, I would continue to raise. I think that the market can handle it. Labor can still handle it. They're not done. Inflation isn't where they want it to be. So if I were there, I'd keep going.
The market's not positioned for a raise tomorrow, is it?
Well,
or do you think it is?
Stocks, these guys all said it. I mean, the stock market seems really okay with rates where they are right now because they wouldn't be rallying like this. Go back to like 2021 when we saw a lot of unprofitable tech, recent IPO tech. We saw SPACs. We saw a whole host of things started selling off well before the Fed did their about face on inflation. I think a lot of the smart money was guessing that they were going to have to battle this. They were going to have to raise interest rates. They're going to have to get back to normalizing interest rates. And I guess what I think we all have to figure out is I think the Fed is not going to get inflation down to 2%. I think that number is going to get ratcheted somewhere between 2 and 4. We have a market now. It's probably 3. So then where does Fed funds find itself in a normalized sort of world where we probably have 3% inflation? And I think some of the things that's going on, I know this word that Guy uses every so often or never.
Which one?
Goldilocks?
I've never, no. Please don't. I was in such a good mood.
Okay, because maybe there's a scenario, though, where unemployment that we've all been talking about, how many strategists do we have on last year? How many times did us, who are not economists, say, where does unemployment have to go? It has to come off of 50-year lows, and it has to go here to get the Fed okay, because that one sticky component of inflation was wage growth, right? So maybe we do live in a world where unemployment stays at a really low level. Maybe interest rates have to stay higher. Maybe we have to become more comfortable with inflation readings that are not 2%, that are maybe 3% or between 3 and 4%. I don't know. And that's the stuff that I think I agree with you. They should do 25. The idea of a pause, if we do see inflation tick back up, the economy gets hotter, then they have to get back to do 50. That's what markets don't like. They do not like uncertainty. So stay the course right now and do the job that you said you were here to do.
What was interesting that we learned from the latest FOMC minutes is that there was a little bit of a sort of a debate on what wage inflation meant and whether prices drove wage inflation or wage inflation drove prices. And do we need to see wages actually come down in order for prices to come down? And so if you separate the two, and if there is that argument and enough evidence to say, you know what, maybe wages are a function of prices in general going higher, then maybe the Fed can leave that job picture okay. Maybe we don't have to see 5% unemployment.
I think that's the bullish scenario is what you just outlined.
That's the no landing, another one of those terms.
That's twice now. You did it, and wait for Karen. We have the trifecta.
Trying to bum you out.
Why not?
I was going to do is hump day.
Oh, see, there you go.
All right,
okay, so that's it. The 3 you have the 4 of you. I'm going home. I'll beat the traffic.
But no landing.
Now, of course, there's going to be a landing. I mean, Julian Emanuel was on last night saying, I'm paraphrasing, and I apologize, but it's almost a foregone conclusion that something's going to happen. I'm surprised it hasn't happened yet. I don't know if that's a good thing or a bad thing. I think with each passing day, it probably becomes worse because people start to feel as if maybe we dodged this bullet. I don't think we've dodged it. I just think the bullet's come yet.
Well, with each passing day, we're also getting just, that broader market. I'm starting to see emerging markets break out. I'm starting to see industrials break out. We're going to talk about airlines. In parts of the economy that we're waiting to kind of normalize, this is the part of where we are. Part of the data today, part of opening up with eggs, was pointing out that there's disinflation in food. So groceries and staples and a lot of these places that have been safety trades, big rotation trades. And I think you're going to kind of continue to see that. If you look at the Bank of America Fund Manager Survey, you're seeing that, look, mega cap tech is still the most crowded trade. And so, some of this has to be worked through. But this is a market that until semis stop making relative highs to Qs and Qs relative highs to the S&P, I think the market's going higher. And I think semis and the Qs are going to test those highs.